Valuing companies is both an art and a science. Different sectors require different approaches depending on the unique financial structures, assets, and market positions. In this video, we'll dive deep into the most effective company valuation methods tailored to various industries like technology, construction, telecommunications, and more. Whether you're a business enthusiast, a financial expert, or just curious, you'll gain insights into how companies across different fields are assessed. Let's get started. Company valuation is the process of estimating a company's market value using a range of financial methods and analyses. Valuation methods vary based on factors like the type of company, its stage of development, and the sector in which it operates. Below are the most important company valuation methods, along with explanations for each. 1. Discounted cash flow, DCF, method concept. This method is based on estimating the future cash flows that the company can generate and then discounting them to their present value using a discount rate. Application. Determine expected cash flows over a specific period, 5-10 years. Estimate the terminal value after this period. Choose an appropriate discount rate, usually based on the company's cost of capital. Calculate the present value of the future cash flows. Advantages. Provides an accurate picture based on expected future financial performance. Disadvantages. Relies on future assumptions, making it susceptible to uncertainty. 2. Market multiples method concept. This method compares the company with similar companies in the same sector based on financial multiples such as the price to earnings, P/E, ratio or the price to sales, P/S, ratio. Application. Select a group of comparable companies in the industry or market. Calculate the average multiples for each company, such as P/E or P/S. Apply these multiples to the company being evaluated using its financial data. Advantages. Quick and easy to use, especially when comparable data is available. Disadvantages. Depends on the availability of similar companies for comparison and may be inaccurate if companies differ in financial structure. 3. Net asset value, NAV, method concept. This method focuses on determining the net value of the company's assets after deducting its liabilities. Application. Aggregate the value of all assets owned by the company, land, buildings, equipment, etc. Deduct debts and liabilities from the value of the assets to obtain the net value. Advantages. Useful for companies with substantial tangible assets like real estate or industrial firms. Disadvantages. Does not consider the company's potential to generate future profits and may not be suitable for companies relying on intangible assets like technology. 4. Comparable transactions method concept. This method compares the company being evaluated to similar acquisition transactions that have occurred in the market. Application. Search for recent acquisition deals for companies in the same sector or of similar size. Compare the price paid in those deals with the financial data of the target company. Advantages. Reflects actual market values based on real transactions. Disadvantages. Difficult to apply if no similar recent transactions are available, or if the conditions surrounding the deals differ from the current situation. 5. Residual income method concept. This method is based on determining the profits that exceed the minimum required return on invested capital. Application. Calculate the net income the company can achieve. Deduct the cost of capital required to generate these profits. The remaining value represents the excess profits that can be used to evaluate the company. Advantages. Takes into account the cost of capital and actual profitability. Disadvantages. Can be somewhat complex to apply and requires accurate assumptions. 6. Market capitalization method concept. This method is used to evaluate publicly traded companies by multiplying the stock price by the number of outstanding shares. Application. Determine the current stock price. Calculate the market capitalization by multiplying the stock price by the number of outstanding shares. Advantages. Easy to apply and reflects the price agreed upon by the market. Disadvantages. Only reflects the current stock price and not the intrinsic value of the company. Best valuation methods by sector. 1. Digital, tech companies best method. Discounted cash flow, DCF, why? Tech companies often rely on strong, scalable future cash flows. Since tangible assets are usually minimal, the focus is on future financial performance. Example, a company like Apple or Google is valued by projecting future cash flows driven by innovations, expansion in services, and product development. Alternative method, market multiples use revenue or earnings multiples to compare tech companies like Tesla or Meta with industry peers. 2. Construction companies' best method, net asset value, NAV, why? Construction companies rely heavily on physical assets like land, buildings, and heavy equipment, making asset-based valuation fundamental. Example, companies like Bechtel or Vinci Construction can be valued by estimating the current value of the tangible assets and subtracting their liabilities. Alternative method, market multiples compare construction companies using earnings or revenue multiples within the industry. 3. Telecommunications companies' best method, discounted cash flow, DCF, why? Telecom companies generate steady, long-term cash flows from subscriptions and network expansions, making DCF an ideal method. Example, companies like Verizon or Vodafone are valued based on cash flows from their subscriber base and digital services, discounted to present value. Alternative method, comparable transactions use recent industry transactions, such as a telecom company acquisition, to gauge market value. 4. Manufacturing companies' best method, market multiples why? Manufacturing companies often use earnings or revenue multiples due to fixed costs and margins that depend on production efficiency and operational costs. Example, companies like Ford or General Motors can be valued using earnings multiples compared to peers in the same sector. Alternative method, net asset value, NAV. Manufacturing companies also have significant physical assets, factories, equipment, that can be valued through an asset-based approach. 5. Retail companies' best method, market multiples why? Retail companies often rely on revenue or earnings multiples due to fluctuating sales and changes in supply and demand. Example, companies like Walmart or Target are valued based on revenue multiples compared to other retail companies. Alternative method, discounted cash flow, DCF. If the company has a large customer base and stable cash flows, DCF can be used to estimate long-term value. 6. Energy and oil companies' best method, net asset value, NAV, why? Energy companies rely on physical assets such as oil fields and refineries, making asset valuation critical. Example, companies like ExxonMobil or BP can be valued based on the net value of their tangible assets. Alternative method, discounted cash flow, DCF. DCF can also be applied if the company has long-term cash flows from exploration or renewable energy projects. 7. Fintech companies' best method, discounted cash flow, DCF, why? Fintech companies often rely on rapid growth and future cash flows, making DCF the best approach. Example, companies like PayPal or Square can be valued based on future cash flows from transactions and financial services. Alternative method, market multiples use revenue multiples or active user base to compare fintech companies with similar peers. Now that we've explored the key methods of company valuation, each with its unique approach and applicability, it's clear that no single method fits all scenarios. By understanding these techniques, you can better assess the true value of a company, whether you're an investor, a business owner, or just someone interested in financial analysis. Remember, the most accurate valuations often come from combining multiple methods to get a well-rounded perspective. If you found this video helpful, don't forget to like, share, and subscribe for more insights into finance and business. Drop your questions or thoughts in the comments below, and I'll see you in the next video.